Silver just dropped 21% in 4 weeks, and the financial media is calling it a correction. They're showing you the chart, pointing at the red candles, and implying the bull market is over. That is exactly the kind of surface-level framing that costs people generational wealth. If you like structural analysis and you want to understand markets the way institutions actually think, hit subscribe, because this channel does not do surface-level framing, ever. Here is what's actually happening. Silver touched $121.64 in January of 2026, its highest price on record. It has since pulled back to approximately $70, and every retail investor watching that chart is asking the same question: is the bull run finished? But that is the wrong question entirely. The right question is this: what structural forces created a move from $33 to over $120 in less than 12 months, and have any of those forces changed? Because if they haven't changed, then this pullback is not a reversal. It is a reload. And the clock on that reload is running out faster than most people realize. The core causal mechanism here, the one this entire video is going to unpack, is a compounding physical deficit cycle colliding with a coordinated geopolitical supply shock at the exact moment that monetary conditions are forcing institutional capital into real assets. That is not a guess. That is a structural description of what is already in motion. Stay with me, because the mechanics of this are not complicated once you understand the incentive layers, and once you see them, you cannot unsee them. The silver market has now been in physical deficit for 6 consecutive years. 6 years in a row where the world has consumed more silver than it has produced. Total global silver supply in 2026 is forecast to rise only 1.5%, reaching approximately 1.05 billion ounces. Mine production, the primary supply source, is expected to grow by just 1% to 820 million ounces. Meanwhile, total demand is running structurally above supply by 67 million ounces. Not once, not twice. 6 years straight of drawing down above-ground inventories to plug the gap. You know what that does to available physical stock over time? It depletes it. And depleted inventory in a commodity market is not a soft warning signal. It is a detonator with a countdown timer already running. Now let me define the mechanism properly, because this is where most commentary gets it wrong. They treat the silver deficit like a minor accounting imbalance that will self-correct when prices rise high enough to stimulate new mine supply. That sounds logical, but it ignores a structural constraint that is almost impossible to overcome. Over 70% of all silver ever mined is produced as a byproduct, meaning it comes out of copper mines, zinc mines, lead mines, gold mines. Silver is not the primary product. It is the secondary extraction. So when silver prices rise, primary silver miners can respond, but they represent less than 30% of total supply. The other 70% responds to copper economics, zinc economics, gold economics. Silver demand can explode, silver prices can double, and the majority of silver supply does not even notice. That is a structural supply ceiling that does not bend to price signals the way textbooks say it should. This is the foundation of why 6 consecutive years of deficit have not self-corrected. The market is structurally incapable of snapping supply upward fast enough to clear demand. And here is where things get structurally dangerous, because that fundamental supply constraint now has a geopolitical accelerant sitting on top of it. In January of 2026, China, which controls an estimated 70% of global refined silver supply, added silver to its rare earth export control list. Read that again. The country controlling 70% of refined processing capacity just made it harder for that refined metal to reach the global market. Simultaneously, the United States government added silver to its critical minerals list. These two moves, taken together, represent a formal declaration by both superpowers that silver is a strategic resource, not a jewelry metal, not a speculative commodity, but a material with national security implications. The moment a commodity gets classified as strategically critical by the world's 2 largest economies simultaneously, the rules of the market change. Institutional buyers do not wait for confirmation when that happens. They accumulate. Stay with me, because this next part changes everything about how you understand the current price pullback. The first structural force driving this market at a deep level is solar energy's dependency on silver that cannot be engineered away on any short timeline. Global solar PV capacity is forecast to reach 665 gigawatts in 2026. That single application is estimated to consume somewhere between 120 and 125 million ounces of silver annually, just from solar panels. Electric vehicle production, forecast at 14 to 15 million units globally, adds a further 70 to 75 million ounces. Grid upgrades and data center infrastructure, the latter of which is exploding due to artificial intelligence build-out, contribute an additional 15 to 20 million ounces. When you add that up, the energy transition alone accounts for over 200 million ounces of annual silver demand. That is not discretionary spending. That is infrastructure mandated by government policy across every major economy on Earth. Solar panels are not optional in the European energy transition plan. EV production lines are not getting mothballed because silver got expensive. These are inelastic demand sources, meaning they consume silver regardless of price, because the cost of silver in a solar panel is a small fraction of total installation cost, and the entire supply chain is already committed. The second structural force, and this one the mainstream completely ignores, is the monetary debasement cycle and its specific mechanical interaction with industrial metals. Here is the sequence that matters. The Federal Reserve is operating under conditions of fiscal dominance, a term that sounds academic, but describes something very specific. When a government's debt burden becomes so large that the central bank's monetary policy is effectively constrained by fiscal necessity. The United States is currently running deficits measured in the trillions annually and carrying accumulated debt at levels that make genuine interest rate normalization structurally impossible without triggering a sovereign debt spiral. This is not a political opinion. This is arithmetic. When the Fed faces that constraint, it has two options: allow real interest rates to rise and watch the debt service costs consume the federal budget, or suppress real rates through inflation tolerance and continued balance sheet accommodation. History says they choose the latter. Every major central bank in history facing the same arithmetic has chosen the latter. And when real interest rates are negative or suppressed, the opportunity cost of holding non-yielding real assets, gold, silver, physical commodities, approaches zero, which means institutional capital, pension funds, sovereign wealth allocations, family offices, all of them face the same internal calculus. Why hold financial assets whose real returns are being confiscated by inflation when you can hold metals with structural deficits and geopolitical demand? The answer is that you shift allocations, slowly at first, then in a wave. Physical investment in silver is projected to surge by 20% in 2026, reaching 227 million ounces. That is the institutional shift beginning to show up in the data. That is not retail speculation, that is capital rotation. The third structural force, and this one explains specifically why the bottom may already be in, is the self-reinforcing dynamic of COMEX paper market mechanics colliding with physical delivery pressure. The COMEX futures market is where most of the short-term silver price discovery happens, and it operates on a fractional reserve basis, meaning the number of paper silver contracts outstanding at any given time represents a claim on far more physical silver than actually exists in COMEX-registered vaults. When the price runs, speculative longs pile in, leverage increases, and at some point the market becomes technically extended. You get a forced unwind, not because the fundamentals changed, but because leveraged positions have to be unwound when margin calls hit or when price momentum reverses. That is precisely what happened from January's highs at $121 down to the current $70 range. Leveraged paper longs got shaken out. Weak hands got margin called. Retail investors panicked at the chart and sold into institutional buying. But here is the part nobody understands. During that same unwind, physical delivery requests on the COMEX have been rising. The number of contracts standing for delivery, meaning buyers who actually want the metal, not just the price exposure, has been climbing persistently. When physical delivery pressure rises while paper price falls, you are watching a temporary paper market correction on top of a physically tightening market. Those two dynamics cannot coexist indefinitely. Eventually, the physical reality reasserts itself in the price, and when it does, the move tends to be sudden and violent, because the paper short positions that suppressed price during the correction get caught wrong-footed simultaneously. Now let's apply this causal chain to the immediate future, because the structural forces we've just walked through have specific time-sensitive implications. The current price, sitting near $70, represents a 21% decline from an all-time high set just 9 weeks ago. In any other commodity, a 21% correction after a 107% annual gain would be considered entirely normal and structurally healthy. Price ran too far too fast, leverage got flushed, and the market is resetting to a level where the next leg can be constructed on firmer positioning. That is standard cycle behavior. But silver is not in a standard commodity cycle. Silver is in a structural demand breakout superimposed on a 6-year physical deficit. With a concurrent geopolitical supply shock and a monetary debasement cycle that is in its early innings, not its late innings, the pullback from $121 to $70 did not change any of those four forces. Not one of them. The deficit is still 67 million ounces for the year. China's export controls are still in place. Solar and EV demand is still inelastic. The Federal Reserve still faces fiscal dominance. What changed is that leveraged speculators got flushed, and that is actually bullish on a forward-looking structural basis, because clean positioning is the prerequisite for the next sustained move higher. The mainstream narrative right now is that silver's bull run was speculative excess, that $120 was a bubble, that the market is returning to fair value somewhere in the $50 to $60 range. That narrative is built entirely on looking at the chart and backward projecting from the price instead of forward projecting from the structural forces. It completely ignores the deficit. It completely ignores the geopolitical reclassification. It completely ignores the inelastic industrial demand base. And it ignores the most dangerous part of the current situation for anyone sitting in cash. Above-ground bullion inventories are being drawn down year after year to fill the gap between supply and demand. At 67 million ounces of deficit in 2026, added to the accumulated drawdown from the previous 5 deficit years, the available physical buffer is getting thinner. At some point, and that point is not decades away, the buffer runs out. When a physical commodity runs out of above-ground inventory buffer, price does not go up gradually, it dislocates. Think about what that means structurally. The very mechanism that has been suppressing price, the release of above-ground stockpiles to meet excess demand, is a finite mechanism. Every ounce released today is an ounce that cannot be released tomorrow. Policymakers cannot print silver, the Fed cannot set a silver interest rate, the Treasury cannot issue silver bonds. This is one of the very few asset classes where the fundamental supply constraint is genuinely immune to monetary policy intervention. And that brings us to where we actually are in the causal chain. The first phase of this silver move, the phase driven primarily by monetary debasement expectations and retail enthusiasm, ran from $33 to $121. That phase is over, and the correction from those highs was the market digesting that first phase move. The second phase, the phase driven by institutional reallocation, geopolitical reclassification, and genuine physical scarcity, has not started yet in full force. Physical investment demand rising 20% this year is the early signal of that second phase beginning to build. The COMEX delivery pressure is a secondary signal. The U.S. critical minerals designation is a third signal. When institutional capital, the real money, not the retail flows, decides to move meaningfully into a market with sub-$1 trillion total capitalization and a structural physical deficit, the price implications are not incremental. They are transformational. The sub-$80 range may genuinely be the last accessible entry window before that institutional phase begins in earnest. Not because of a chart pattern, not because of a technical support level, but because the structural forces driving this market upward are compounding, not linear, and compounding forces do not give you gradual warning signals before they accelerate. They give you a pullback that looks like a reason to sell, and then they move without you. Here's the blunt structural read. Silver is currently trading at approximately 58% of its January 2026 all-time high, in a market running a 67 million ounce physical deficit for the 6th consecutive year, with its largest refiner having restricted exports, and with the world's largest economy having just formally classified it as a strategic critical material. If this were a technology stock, the headline would be, "Once in a decade buying opportunity." Because it is silver, the headline is "Correction deepens." That asymmetry in narrative framing, that gap between what the structure says and what the media reports, is where generational positioning opportunities live. You do not need to make a specific bet. You do not need to predict the exact timing of the next move. What you need to understand is the direction and the magnitude of the forces in play, and those forces are structurally, mechanically, and geopolitically aligned in one direction. The question is not whether silver goes higher from here. The question is whether the institutions finish their accumulation before the mainstream finally catches on and bids the metal away from you. And here is the thought I want to leave you with. Every major monetary regime transition in history, every single one, has involved the repricing of real assets relative to financial assets. We are currently in the early to middle stages of the largest monetary regime stress test since the 1970s. The difference this time is that the industrial demand base for silver is structural and mandated by global energy policy in a way it has never been before. The last time silver was in a 6-year physical deficit with monetary debasement accelerating, it did not stop at $80. It went to $50 in nominal terms in 1980, which in today's purchasing power is a number that would make your head spin. The world has more solar panels now, more electric vehicles, more data centers, more geopolitical fragmentation, the same monetary math, and 6 fewer years of inventory buffer than it had when this deficit cycle started. Think about that.